The first 3 months of 2015 have been good ones for the IPlus portfolios. The underlying investments have returned between 3% and 5%. As a result, the IPlus portfolios are ahead of their respective inflation plus 3 to 6% targets year to date. While it may not have felt like it at the time, the UK equity markets had a reasonable 3 months, with the UK all-cap market, the index of all shares, up by 4%. The gilt market also performed well with a total return of 2.3% as yields came under pressure. In local currency terms, the US, Japanese and European equity positions in the fund also performed well, with the US and European returns both in double figures. The US dollar also added value over the month, and as a result, the allocation in the fund to US fixed interest securities, such as high yield and emerging market debt, benefited from this asset class price move combined with the currency move on top. The funds also benefited from manager selection in the UK, with their underlying managers on average outperforming their benchmarks. In an environment where markets have drifted up but not made significant strides, our views of valuation will not change much. As a result, we've not seen the need to make significant alterations to the investment approach in the funds because we believe their positioning over the quarter is where we want to be looking to the future. There have been some minor tweaks to positioning on an ongoing basis, but no noteworthy changes in the funds over the past 3 months. The funds remain well allocated to a balanced mix of UK equity strategies, and these holdings have complementary and somewhat offsetting characteristics, which together creates what we believe to be an optimum allocation to the UK equity market. We also augment this position in the UK with allocations to the Japanese stock market and also to European stocks. And this is because we think that the UK, European and Japanese stock markets are attractively valued, and as a result we want to have a meaningful allocation to those markets. On the contrary, we deliberately underweight the US equity market because we believe it to be expensive. There's a lot of good news priced into the US, and we think there's a greater risk of disappointments either from the corporate sector or macroeconomic data than there is in the 3 other markets just mentioned. We also make use of a couple of more focused strategies such as infrastructure securities, Copernicus Global All-Cap Contrarian holding, and a position in gold mining shares. Within the fixed income buckets, we're underweight gilts and overweight a variety of areas of the credit spectrum, including investment grade, high yield, convertible debt, emerging market debt, and loans. We retain a reasonable cash balance as it represents modest value compared to government debt and also useful to put to work as and when valuation opportunities present themselves. Markets will remain dominated by central bank actions in the months ahead. While the US Fed removed its patience comment at the end of this month's FOMC meeting, at the same time it revised down its growth and inflation forecasts, indicated greater slack in the economy than previously forecast, and dramatically lowered its future interest rate expectations, cutting these by around 0.5% over the next 2 years. So it seems that lower for longer remains the mantra, supported by slower growth in recent months and weak payrolls numbers, increasing the possibility, not yet a probability, of no rise until 2016 of interest rates. At the same time, there is absolutely no doubt that the ECB and Bank of Japan will keep policy ultra loose, and the Bank of England has put back its first rate hike almost certainly until 2016. So the world remains awash with liquidity, keeping bond yields at exceptionally low and highly unattractive levels and providing support for equities. While there are clear risks, none of these appear to be potentially damaging enough to result in a renewed bear market. There will be periods of consolidation, but there are sound reasons for believing that this very long bull market and cycle still has further to run. We've had a number of people mention to us lately that as inflation has fallen to near zero in the UK, it's simpler to beat. And that is true to an extent, but it's important to remind ourselves that we're invested in capital markets which are, by their very nature, more volatile than inflation time series, which tend to be gentler in terms of their movements. And the key thing from my perspective is to remain vigilant with respect to future inflation. And the move down in inflation over the past 6 months or so is a result of the falls in oil as much as anything else. And this is a one-off move, and the price of oil has stabilised over the past couple of months. As a result, we think inflation is likely to firm up soon and we need to bear this in mind when constructing the funds today, because somebody making an investment with us is not going to be particularly impressed by how we did 6 months ago before they invested. They're only worried about what we plan to bring to them in the future. People are also worried about the number of headlines we're seeing about disinflation or even deflation today, and asking whether this is an issue for the economy. Our view is that deflation, when it becomes ingrained and persistent, is very bad news for an economy, because people put off spending, consumption, in other words, they would normally make today for another time, because if they can get it cheaper in the future. If this behaviour becomes entrenched, it's bad news for an economy, especially one like the UK's that's reliant on consumer spending, but that is not, in our opinion at least, the sort of deflation we're seeing today. Again, this looks much more like a deflationary spike thanks to one-off precipitous drops in oil rather than a symptom of genuine economic slump. Indeed, a lot of other indicators of the UK economy are actually pretty good, and that causes us to remain broadly constructive on the prospect for the UK market.